Every crisis is sold as a tragedy. Jobs are lost. Businesses close. Savings vanish. Governments declare emergencies and promise to do whatever it takes. But here's the question no one asks out loud. If crises are so destructive, why do the same institutions always emerge bigger, richer, and more powerful afterward? Market crashes wipe out ordinary investors, yet financial elites buy assets at record discounts. Recessions destroy small businesses, yet megacorporations consolidate entire industries. Bailouts are framed as rescue missions, yet wealth inequality widens immediately after. So here is the mystery that challenges the official story. How can a system repeatedly fail for the public, yet succeed so consistently for those at the top? Tonight, we read going inside the system that doesn't just survive crises, it profits from them. Setting the stage crisis as an accident, we're taught to see financial crises as unpredictable shocks. A housing bubble bursts. A bank makes a mistake. A virus shuts down the economy. A war disrupts supply chains. Each time the explanation is the same. No one could have seen it coming. Crises don't appear randomly. They follow patterns. They repeat mechanisms. And most importantly, they create opportunities that only a few are positioned to exploit. To understand why, we need to go back to when finance stopped being about stability and became about leverage. Origins when risk became a business model in early capitalism, risk was personal. If a merchant failed, they went bankrupt. If a bank collapsed, it disappeared. Losses were painful and final. This created discipline. But over time, financial systems evolved in a way that quietly removed consequences for those with scale. Limited liability laws protected investors. Central banks acted as lenders of last resort. Governments guaranteed deposits. Each innovation reduced risk, but only for the largest players. And here's the critical cause and effect shift. When losses are socialized but gains remain private, risk-taking becomes profitable. Crises stopped being existential threats. They became calculated events. The rise, the institutionalization of rescue by the 20th century, large financial institutions were no longer just participants in the economy. They became systemic. Their failure would threaten everything, or so the argument went. This changed the rules. If small businesses failed, it was market discipline. If major banks failed, it was systemic risk, and so bailouts were born. At first they were rare, then occasional, then expected. Markets learned a powerful lesson. During booms, profits were unlimited. During busts, losses would be absorbed by the public. This expectation didn't reduce risk-taking, it supercharged it. The breaking point, when failure becomes opportunity eventually, the system reached a point where crises weren't anomalies. They were features. Asset bubbles grew larger. Leverage increased. Complexity hid risk. And when collapse came, it triggered a familiar sequence. Markets crashed. Assets lost value. Liquidity dried up. For ordinary people, this meant layoffs, foreclosures, and wiped out savings. For financial elites, it meant something else entirely. Opportunity. Because while the public faced scarcity, those closest to money creation faced abundance. Fallout buying the world at a discount, here's how crises become profitable. When markets crash, asset prices collapse, not because they lose usefulness, but because confidence disappears. Stocks fall below intrinsic value. Real estate sells under replacement cost. Entire companies trade for fractions of their worth. Who has the liquidity to buy at this moment? Not workers, not small investors, not struggling businesses. It's institutions with access to credit, bailouts, and central bank support. While the public is told to tighten belts, financial elites are quietly expanding balance sheets. Crises transfer ownership from weak hands to strong ones, from dispersed ownership to concentrated control. This is not accidental. It is structural. Failed fixes why reforms never stop the cycle after every crisis. Reforms are promised. New regulations, stress tests, transparency rules, ethical commitments. And for a while, things seem calmer. But the incentives never change. Profits remain private. Losses remain shared. Scale remains protected, so risk migrates, but never disappears. Shadow banking replaces regulated banking. Derivatives replace traditional loans. Complexity replaces clarity. Each reform addresses the last crisis, not the next one. And those with resources stay ahead of regulation. The deeper mechanism: access, not intelligence. A common myth is that financial elites profit because they're smarter. But intelligence isn't the key advantage. Access is. Access to cheap credit, access to central bank facilities, access to political influence, access to insider timing. When crises hit, speed matters more than foresight. Those who can act immediately capture value. Those who must wait absorb losses. This is why inequality spikes after crises, not despite interventions, but because of them. Modern parallels: the pattern accelerates. Look at recent history. After major financial collapses, wealth concentration increases, corporate consolidation accelerates, asset prices recover faster than wages, higher sectors are absorbed by a few dominant players. The justification is always efficiency, stability, competitiveness, but the outcome is predictable. Fewer owners, more control, greater dependency. And every crisis reinforces the same lesson: those closest to power never truly lose. Why crises are never wasted there. A phrase often attributed to powerful strategists: never let a good crisis go to waste. Crises justify actions that would be rejected in normal times. Emergency laws, massive spending, policy shifts, market restructuring. Under the banner of urgency, resistance disappears. And once changes are made, they rarely reverse. Temporary measures become permanent architecture. The system expands during panic and never fully contracts. The illusion of recovery: eventually, headlines declare recovery. Markets rebound, GDP stabilizes, confidence returns. But recovery isn't evenly distributed. Asset owners are restored, institutions are recapitalized, elites are repositioned. Meanwhile, households carry more debt, fewer assets, and greater insecurity. System recovers, but people don't. The repeating loop here is the full cycle. Expansion, fueled by leverage; collapse, triggered by excess. Public absorbs losses, elites acquire undervalued assets. Power consolidates, the cycle restarts. Bigger each iteration leaves the system more concentrated and more fragile. And each time, the narrative resets. It's unprecedented. Once in a lifetime, lessons learned. But the structure remains. 3 clear takeaways. First, crises are not just economic failures, they are transfer mechanisms. Wealth and control move upward during instability. Second, financial elites don't win because crises are unpredictable. They win because the system protects them from permanent loss. Third, as long as gains remain private and losses are shared, crises will remain profitable for those positioned closest to power. Final warning: the uncomfortable question, the most dangerous idea, is believing this system is broken. Because broken systems get fixed. This one doesn't break, it feeds. The real question is not whether another crisis will come. It's whether the public will recognize the pattern before ownership, influence, and choice concentrate beyond recovery. Because once crises stop transferring wealth, the system itself must change. Call to action: if this video helped you see crises differently, subscribe for more deep dives into the hidden mechanics of finance and power. Share this with someone who still believes every crash is just bad luck. Remember, in a system where crises are profitable, instability isn't a failure, it's a feature.